On the morning of May 10th, 2022, a software engineer in Seoul opened his phone and watched his retirement disappear in real time. The number on his screen had read $212,000 the night before. Now it read $63,000. By lunch, it would read $9,000. By the following morning, it would read $11. He wasn't gambling on some obscure token. He had placed his savings into what he was told was the safest corner of crypto, a digital dollar, a stablecoin pegged to $1, earning a steady 20% annual return. It was supposed to be boring. It was supposed to be reliable. $45 billion in combined market value evaporated in less than 72 hours. Not from a hack, not from a single transaction, from a design flaw that one man refused to acknowledge, buried inside a system that millions of people treated like a savings account. The man behind it was Kwon, Stanford-educated, Forbes-listed, and so confident in his creation that he publicly wagered $10 million it would never fail. He lost that bet, and then he ran. But before the collapse, before the arrests and the extradition flights, before the congressional hearings and the suicide hotline posts flooding Reddit, there was a moment when this system looked like the future of money. Understanding how it got there is the only way to understand how it fell apart. Empire building. Kwon was born in South Korea in 1991. He studied computer science at Stanford, graduated in 2015, and took brief positions at Apple and Microsoft. Neither lasted more than a few months. He wasn't interested in building someone else's product. He wanted to build the infrastructure itself. Back in South Korea, Kwon encountered stablecoins. The idea was straightforward: a digital token that always equals $1. Unlike Bitcoin, which swings wildly, a stablecoin holds steady, the bridge between traditional money and the crypto economy. In January 2018, Kwon and co-founder Daniel Shin launched Terraform Labs. They secured backing from 15 e-commerce companies across Asia and integrated with Chai, a Korean payment app processing millions of transactions. Terra wasn't theoretical. People were spending it in grocery stores. By 2019, Forbes named Kwon to its 30 Under 30 Asia list. By April 2022, Luna traded above $100. The ecosystem was valued at $45 billion, the fourth largest in crypto. To the outside world, Kwon had built a functioning digital bank. To insiders, the picture was different. Staff described him as narcissistic, controlling, and verbally abusive. Within 2 years, nearly every original team member had departed, many through legal disputes. Terraform Labs had become a one-man operation, and that one man was about to make decisions no one could override. Most stablecoins are backed by real assets like dollars or treasuries. Terra took a different approach. UST was backed not by cash, but by an algorithm connected to a second token called Luna. The system worked like a seesaw. If UST drifted below $1, traders could swap it for Luna, pocketing a small profit and reducing UST supply, pushing the price back up. If UST rose above $1, new UST could be minted using Luna, increasing supply and bringing it down. The algorithm managed this automatically. Think of it like a thermostat. Small fluctuations trigger small corrections. But this thermostat had no backup generator. If the temperature dropped too fast, the system would overcorrect and spiral. If too many people sold UST at once, Luna would be printed at enormous scale to absorb the shock. But printing diluted Luna's value. As Luna fell, more needed printing, which made it fall faster. The correction mechanism became the accelerant. This was the death spiral. Now layer on a critical decision. To attract users, Kwon offered a fixed 20% annual return on UST deposits through Anchor protocol, 20% guaranteed. in a world where savings accounts offered less than one. This was subsidized by Terraform Labs at $7 million a day. People poured in. The system grew massive. But it grew on a promise sustainable only as long as new deposits kept arriving and nobody tried to leave at once. Kwon also allowed instant withdrawals, no waiting period, no lockup. The combination was lethal. An artificially high return, no withdrawal restrictions, and a backing system that couldn't survive a bank run. Red flags. The warnings came from multiple directions, and they came early. Kevin Zhou, founder of Galois Capital, publicly laid out the exact failure scenario months before the crash. He described the death spiral mechanics in detail on Twitter and in interviews. Kwon dismissed him publicly. When a user bet $1 million that Terra would collapse within a year, Kwon raised the stakes to $10 million and posted the bet on the blockchain for everyone to see. In December 2019, a speaker at a blockchain conference delivered what would become a chillingly accurate prediction. He described a scenario where an algorithmic stablecoin with no real backing would gain massive adoption among ordinary people who just wanted to preserve their savings, and then blow up, causing devastating losses and regulatory backlash. He specifically named Terra as a candidate. Senator Elizabeth Warren had already been calling stablecoins modern-day pyramid schemes and pushing for regulation. Mark Cuban, a billionaire investor, had lost money on a previous algorithmic stablecoin called Titan Iron that collapsed in identical fashion. The pattern was documented. The precedent existed. And then, just days before everything fell apart, Kwon filed to dissolve Terraform Labs' Korean entity. The application was submitted on April 30, 2022, and approved on May 4th, 5 days before the crash. This was a matter of public record, but the people who had entrusted their savings to the system either didn't see it or didn't understand what it meant. System failure analysis. The crypto ecosystem in 2021 operated in a regulatory void. No SEC oversight of stablecoin reserves, no audits, no consumer protection. Terraform Labs marketed itself as decentralized, meaning no jurisdiction claimed authority over it. But the reality was centralized. Kwon set the interest rate, managed reserves, and directed the Luna Foundation Guard's $1.5 billion Bitcoin buffer. The decentralization was branding, not architecture. The incentive structures created willful blindness. VCs had invested heavily. Crypto media depended on the ecosystem's advertising. Luna holders, self-named lunatics, attacked anyone who raised concerns. Criticism was treated as betrayal. When enough people profit from a system, questioning it becomes expensive. The loudest voices are always those with the most to lose from the truth. Collapse. On May 9th, $4 billion was withdrawn from Anchor. A single wallet dumped $84 million in UST on Ethereum. Another $108 million hit Binance. Whether coordinated attack or panicked exit, the result was the same. UST slipped to 90 cents, then 85. The algorithm printed Luna to compensate. Luna fell. More people tried to exit. The network congested. Panic compounded. The Luna Foundation Guard deployed its entire $1.5 billion reserve. It failed. UST fell to 50 cents, then 20, then 10. Luna crashed from $119 to 5 cents, to zero. Its supply hyperinflated from 350 million tokens to 6 trillion. On May 13th, Terraform Labs halted the blockchain. $45 billion had ceased to exist. Human cost. A Reddit user wrote he had lost $450,000 and could not pay his mortgage. He said suicide was his only option. Forums flooded with crisis hotline numbers. KSI lost $2.8 million. Carl Runefeld lost $1.4 million. But thousands of ordinary people in South Korea, Southeast Asia, and Latin America never spoke publicly. Hash confirmed losses exceeding 3 billion. The contagion spread. Celsius, Three Arrows Capital, and eventually FTX collapsed in the months that followed, each domino traced back to Terra. Psychological autopsy. Kwon was not a traditional con artist. According to insiders, he believed in the system. But belief and competence are different things. His persona was built on certainty. He mocked competitors. He bet millions on his creation. Admitting doubt would have undermined the confidence holding everything together. In algorithmic stablecoins, confidence is not a byproduct, it is the product. He dissolved his Korean entity days before the crash. Fled South Korea, was arrested in Montenegro in March 2023 with a forged passport, extradited to the US in December 2024, pled guilty in August 2025, sentenced to 15 years that December. The judge said he'd been bitten by the crypto bug. But this was not enthusiasm gone wrong. This was a man who built a system he couldn't control, refused every warning, and kept the doors open while the building burned. Reflective ending. $45 billion is more than the GDP of over 100 countries. It vanished in 3 days, not from a hack, but from a design choice, backing a currency with nothing but code and confidence. The people who lost money were not reckless speculators. They chose the stablecoin because they wanted safety. They were told by the founder, the community, and the yield itself that safety was exactly what they had. The deepest lesson of Terra is not about crypto. It is about what happens when a financial system is built on the assumption that trust, once earned, never needs to be tested. Terra proved that when belief is manufactured rather than earned, collapse is not gradual. It is instant. The algorithm worked perfectly, right until it didn't.